I'm not that older. And thank you for giving the brief introduction. We should move ahead. So before starting, I just want to let you guys know that how it all started. So when we passed out from IIFM in March 2020, I'm from 1820 batch. So we were all in our respective homes and uh, uh, doing nothing more than just watching series, movies, playing Ludo tournaments. So that was the first lockdown situation. So I just, while scrolling through YouTube videos, I just started seeing how these financial terms work, and how people invest in stock markets. And there were a huge news that stock market is going down, and everyone is losing money. So I started scrolling few videos, and from there I got this a bit of knowledge. And I'm also a beginner in this sector, and still learning. So I'll just go through the through my learnings till now, and how I invest in these two instruments. There are a lot of instruments in financial sector which we can invest, but these are the two where I am investing currently, and I will speak about it a bit. So moving ahead, first of all, uh, everyone is aware that what is budgeting and saving and investing. So this is the basic concept. This is the concept from where I started. Even though at that point of time, I did not join any organization. I joined in October 2020. So I started learning like how we can create a budget, what and what all heads falls under expenses and income, and what is saving and what is investing, and how saving and investing are two different terms. So for example, saving is a technique where you just keep some money aside for future goals, such as maybe you are going on a vacation 1 or 2 months down the line. So that is called saving. So the money which is saved, such as emergency fund, for example, is saving for your needs of your 6 months expenses, or maybe 1 year. So that is called saving, where the money is not growing, and you keep your saving in maybe your saving account, or maybe invest in FD. So that is called saving. Talking about investing, investing is a concept where your money is growing, like it is a income. It is a income you are getting in terms of maybe interest, or maybe you are uh, creating more money by investing some amount of money in various instruments. So that is the basic concept I understood. And in the budgeting part, like I used to create an Excel where I am bifurcating which all expenses I'm having, and which all expenses are falling under various category. Moving ahead, so before we talk about these instruments, let's talk about the goals and the risk tolerance level. So basically, there are three terms like for that you should invest. For example, short term, which the short term are the investment criteria where you need the money which you have invested in less than 2 years. For example, you are going on an international trip, so you want to save for it. So that comes falls under a short term goal. And medium term is between 2 to 5 years, such as someone is planning to have a higher education within 5 years down the line. So they can save for that particular goal as a medium term instrument. And then there is a long term, which is something around more than 5 years, such as uh, saving for your buying a house, or maybe saving for your retirement. So that all goes fall under long term. So basically, we save or we invest according to our goals, what we want in near future, or maybe 5 years down the line. And risk tolerance, like we decide where to save and in which instrument we should consider. So in stocks and in mutual funds also, there are varieties of mutual funds available in the market. So that selection of the mutual fund or maybe stocks comes this like comes fine we can finalize that basis on the risk tolerance, like how much risk we can take in the near future. So we should not invest in a short term for a short term period, like less than 2 years, in a share market, because we never know what will happen after 2 years. It may fall down and you will not be able to sell those stocks and gain the interest. Maybe it is in so much of bad condition that you if you will sell that, you will lose all your money. So that is the situation. According to the goal, we decide in which instrument we should invest in. Uh, so, m- so talking about the bifurcation of your monthly income. So this is the rule which is there all over on YouTube, and you can follow according to your needs, and you can decide for yourself. Such as this is the rule everywhere, that 50 20 30. So we should bifurcate our monthly income: 50% of the monthly income for our needs, and 20% for our wants, and 30% for our investment. um it's not a hard and fast rule. The important thing is how persistently you are sticking to this rule. Maybe you can, if you can calculate that what all needs are there, how much liability are there on you. Maybe you are taking care of parents, maybe you are paying the health insurance EMI for your parents, or maybe you are paying a EMI for your home loan. So all those caters to your needs. That is the needs of your monthly expenses, which you cannot avoid. So no, that needs amount can be 60% of your monthly income, or maybe 40 or 30% of your income. Like for example, who are not having any liability, and they are just taking care of their alone expenses, and they can just keep the needs as low as 30%, or maybe 25%, 35%. That may vary. For that, you need to calculate like which all bills you are paying: electricity bill or maybe gas bill. These are coming under the needs. And health insurance EMI, any term insurance EMI, or any loans EMI you're paying. So all those expenses will fall under needs. Then we are talking about the wants. So wants can be going on a vacation, shopping, movie, or buying a new vehicle. All these will fall under wants, like what you want to have in your a monthly income. Maybe you are planning to buy a mobile phone, new phone, so that is also falling under wants. And then investment, that is the part we will discuss moving ahead. So investment, anything which you are investing in: mutual funds, maybe stocks, real estates, NPS, gold, or bitcoins. So moving ahead, uh, as I have seen the last session of Manmeet, and she has already discussed about assets classes. And so here we will more discuss about the type of mutual funds in these asset classes falling under. Like there are equity, where ownership in companies by buying its shares. So if you are investing in equity, you are actually buying those shares, and you are gaining the ownership in that particular share. Maybe Reliance, maybe Geo, or maybe any share of Tata. And debt are the asset class where you are giving the loan to companies or governments, and in return you are receiving interest. So from the interest you are earning money. So that is the question basically comes in our mind, that how much we should invest in equity and how much we should invest in debt. So this is also a formula all over the no, internet, that if a person is of 25 years age, and if we minus 100, like if we minus 25 from 100, so the 75% of the amount which is there, which is coming, that percent is to be invested in equity, and the age, person's age, will should be invested in safer instrument, let's say debt, or maybe FD, or any other safe instrument which you know about. And talking about like how we can select the mutual funds for let's say in equity or debt mutual funds. So next, moving ahead, we will discuss about the mutual funds, like selecting the mutual funds from all these categories. There are a lot of mutual funds available. There are a lot of platforms available from which you can select those mutual funds. So, equity mutual funds basically invest in stock markets, and debt mutual funds basically invest in corporate bonds, government bonds, and generate fixed rate of return. So, the rate of return of these debt mutual funds generally does not vary according to the stock market movement. It is not that like fluctuating as per the movement of the stock market. And hybrid mutual funds are those mutual funds which invest both in equity and debt, so that it can give it can give a near to, not constant, but good return, but not that fluctuating. So like how to select these mutual funds. So I have drawn one matrix, 3 by 3 matrix, and on x-axis we have the investment period, like you want to invest for short term or maybe mid term or for long term, and then what is your risk appetite. So talking about the risk appetite, maybe like who is just passed out and started working, their risk appetite will be high, so they can take high risk. And the people who are in mid 40s 50s, their risk appetite is not that high, so that no, they cannot invest much in high risk instrument. So for example, if you want to invest in long term and your risk appetite is low, so you should invest in large cap mutual funds. Large cap mutual funds basically are the ones who are having low risk, and they generally invest in top 100 companies of India. Blue chip, we can also call them blue in a investment strategy where they invest in blue chip stocks, which are top 100. Then if your risk appetite is medium and you want to invest more than for 5 years, so you can invest in mid cap mutual funds. And mid cap mutual funds are the funds where the mutual funds, the fund manager invest in the mid-sized companies. Those are beyond 100, and it is in the range of above 100 and below 250. So these are the mid-cap size companies of India where the fund managers invest. If you are having a more than 5 years or tenure and you want to take high risk, you have the ability appetite of high risk, so you should invest in small cap mutual fund. Though these are the organizations where the fund manager invest in beyond 250 companies of a stock market. So these are small cap mutual funds. When we are talking about midterm, like 2 to 5 years of tenure, so for that, similarly, if you are having low risk appetite, you should invest in balanced large cap mutual fund. And also for medium risk appetite, you should invest in balanced large cap mutual fund. These are the investment strategy where large cap equity shares and these balanced large cap mutual fund also invest in debt part, like few percentage are invested in debt, and so that fixed rate of return is coming, and few percentage of the amount is invested in equity shares, but large cap equity shares. If you have a high risk appetite for medium term, you should go ahead with multi cap mutual fund. Multi cap mutual fund only invest in equity funds. That those equity funds may vary from large cap, mid cap, and small cap. So that percentage is decided by the fund manager of the particular fund. There are variety of multi cap mutual funds available in the market and available on various platform, and those funds generate generally higher return than these large cap mutual funds. But yes, this is a bit of risky instrument. Talking about short term duration, like within 2 years, we should for short term duration, if you have low risk appetite, you should invest in debt mutual funds such as liquid funds, um liquid funds for medium risk appetite. Debt mutual funds are specific funds where the fund manager investing their money by giving loans to government bonds, corporate bonds. So the rate of return will be somewhat near to 6-7% annual rate of return. It is similar to fixed deposit return, and the risk appetite is very low in that, and it is good for short term, like if you want to park your money somewhere for 1 year or 2 years, and you want to use that money afterwards. Similarly, for medium risk appetite, you can invest in liquid funds. Like you can park some amount of your emergency fund in liquid funds where it will grow by 6-7% of rate of interest, and whenever you want to withdraw, you can just withdraw those liquid funds. There is no exit load, there is no charges, but capital gain charges will be there. Now, talking about the high risk appetite for short term funds, so we can use the hybrid funds for the investment purpose. Hybrid funds generally invest in both of the instrument, as mentioned earlier. So generally mutual funds are like you can select the mutual funds basis on four of the parameters. Whenever you will use a platform, in that platform all these four parameters must be mentioned, such as expense ratio. So expense ratio should be less than 1%. These expense ratios are charged by the fund managers as a fee, and you should consider mutual funds whose expense ratio is less than 1%, because whenever you will withdraw some amount, that 1% will be deducted from that profit you are getting. Exit load are there for not all the funds, but few of the funds where there is exit load for example, if you are investing buying some mutual fund and you are withdrawing within 1 year. So if you are withdrawing within 1 year, exit load will be applicable on that profit, so it should be between 0 to 1% exit load. Generally for longer period of investment, like for medium term and long term, it is not there. It is there for the short term investment, like with if you are withdrawing within 1 year. Then size of the fund, you should always consider look into the what is the fund size, how much assets under management, what is the like how much big it is. It generally falls under 20, like it if it is highest, then it will be good, because that depicts that how much people have invested their money in that particular fund. So as I am aware, SDFC is having the highest AUM. So you can this was not an recommendation, but you can check that uh, how much AUM a mutual fund is having. Then long term return, you should always look for what is the 5-year returns of that specific mutual fund, and also you will get a option to see how that particular mutual fund is performing uh, in respective in comparison to other mutual funds in the similar sector. So, talking about the mutual funds, like we know, we can invest as a systematic investment plan, and then we can invest as a lump sum investment. So, systematic SIP we generally do, where every month that particular amount will be deducted from your account. So, no, SIP will be good for the people who are getting their monthly salary, and also it will be good because you cannot time the market. So, let's say you are fixing a SIP for a second of every month. So, the market is uh, fluctuating, and if the market is up, then also you are investing on second of every month, and the market is down, then also you are investing on second of every month. So that will average out your return. If you are doing lump sum investment, you can consider lump sum investment on the scenario that you are getting you are having some extra amount, so you want to invest somewhere, so you can put it in some mutual funds as a lump sum investment, such as if you are receiving bonus, so you can invest that in lump sum amount. But in the lump sum amount scenario, you cannot average out the market. Like if on the particular date on which you are investing, on that particular date, if market is uh, very performing well, so you will get very less amount of mutual funds as per the NAV. Apart from this, in mutual funds, like there are a lot of mutual funds, sector-based mutual funds. Then there are ELSs, where we generally get tax benefit in under ATC. So these are the mutual funds you can invest in. You can go ahead and explore the type of and category, and according to your requirement, you can invest on those. These are the basic steps I usually follow. Moving ahead, let's talk about the stock. So, how to select stock? So basically, when I started investing in stocks, so I started by selecting any blue chip company, such as uh, maybe Tata, or just going to Money Control website and selecting the top 100 stocks of India, and just checking their details. But basically, these are the criterias which we should look upon, like what is the alpha, what is the beta, and how much revenue growth that particular organization is having. So there are various platform available in the market, such as Screener, Ticker Tape, where from where you can get these data. So talking about alpha, alpha is a number, the difference between how stock return and index return is there. So for example, if a stock is giving much more return than the index, that is the Sensex or maybe Nifty 50 index. So that difference is alpha. So everyone wants the stocks which they have invested in that should perform better than the index, but that is not the case always. So that is basically the meaning of alpha. When we talk about beta, beta is the measurement of volatility or risk. So beta should be nearby one, and the meaning of the beta is like how that stock is behaving when index is down. So let's say if a stock is falling, the index has fallen by let's say 10%, and the beta of a particular stock is let's say uh, 5. So that means that that particular stock will fall 5 times the index. So that will be a risk condition that depicts how risky that stock is. And if the beta is on lower side, for example 0.5 is the beta, So it shows that that stock, if particular index is falling by 10%, so that particular stock whose beta is 0.5%, 0.5, that will fall only by 5%. So as beta is low, that will be better for investors like us. And we'll also check about 5 years revenue growth, like how it is behaving in the past 5 years. I mean, that is also not a no, that is also not a good way to depict that it will, if it is performing well in 5 years, then also it will perform in the similar fashion for the next 5 years. That is, but that is one of the criteria we should check. Talking about this graph, so basically the x-axis is depicting the alpha value, and here the alpha is low, and this is the high alpha, and this y-axis is depicting the beta value. So this is one high, and this is low. This is zero. Sorry, this is minus. So when we talk about these four quadrants, uh, we should always pick stock which is for long term investment, like uh, that is called passive trading. We should also look for the in stocks which are having low beta and high alpha, that it is giving high rate of return, but it is having low risk assigned to that particular stock. That is called passive trading or long term investment. When we talk about all these three quadrants, here the stocks which are having low beta, low risk, and then low in rate of return, so that means the stock is not performing. I mean, that amount which you have invested in that particular stock, let's say for example, um Vedanta or Hindustan Zinc. So these stocks are giving dividend. So they are actually the way of earning from these stocks are they are giving dividend on maybe like very frequent or every quarter, like half yearly. So people are earning through dividend. Dividend yield of these stocks are high. Like the if you have invested 1 lakh in Vedanta Limited, you will get the dividend for that 1 lakh, maybe 45%. You are earning 45% of that 1 lakh in one financial year as a dividend. And then the value of that stock will not move. That 1 lakh rupees will not increase. It will increase approximately by 6 to 7%, not much more than that. Then we talk about this quadrant where the beta is high and the alpha is low. So this is like the risk is high and the rate of return is low. So this is basically preferable for the day trading, like those who are investing in the, like buying some stocks in the morning and selling by end of the day, like by 3:45 whenever the stock market stops. So that is for day traders. This is not at all preferred because we don't know how that stock behave, and we might lose a lot of money in this in these kind of day trading. The experts can do that. I am not preferring that. Then when we talk about the third quadrant, that is high alpha and high beta, the risk is also high and rate of return is also high. That is also for active trading, those who have the experience. And this strategy is called momentum strategy. So people here bet on the momentum of a particular stock, like they get the news and they says that this particular stock will in like increase, the price of that particular stock is will increase, and then they just buy it and then sell by the end of the day. So this is the percentage of sectors which are there in the top 100 stocks of India. So 30.85% of financial services companies are there in the top 100 stocks. Similarly, 10.8% for oil and gas consumable fuels, and 10.98% by IT companies are there in top 100 stocks. So you can also check the top 100 stock list, and you can also, if you want to invest, let's say X percentage of amount on a monthly basis in stock market, so you can bifurcate allocate that X percentage according to the financial organization. You can select one or two companies from financial services, one from FMCG, one from automobile, and then you can invest that amount. Apart from this, there are no, few more technique which we use for selecting the stock. Like in screener, you will get the option of selecting the stock by market's capitalization. So obviously that market capitalization is the amount of money invested in that particular share, that particular companies, by all share, like by all investors. So it should be high, as high as possible. Then free cash flow, that should be high. Free cash flow means the amount the particular organization is having with them, like liquid cash flow is available for them, with them, for paying all the expenses, and for paying any amount in operating their businesses. And then return on equity. Return on equity is a parameter. It shows like how much profit a company is making for every 1 rupee. We go for return, we check one return on equity of a particular share. It should be like at least 15%, uh, uh like depending on which sector it is belonging to. And also we should also check one P ratio for particular stock. So P ratio is basically like, it will tell you how any investor is willing to pay for that particular company earning. For example, to P ratio will be given in various platform, but P ratio actually depicts like what is the market price of a particular share, like one share, what is the market price per share divided by the earning per share. And that earning per share is also calculated in a particular way, like profit after tax divided by number of shares. So we also go for we check for P ratio. It should be high. And the industry P ratio is also given in on those platforms. So we see that the stock is undervalued or overvalued. If the P ratio of a particular stock is above the industry average, it should be it is overvalued. And if a P ratio is less than the industry average P ratio, so we can depict that it is undervalued. Then all we can also go ahead with fundamental analysis and technical analysis. So fundamental analysis may we should check the balance sheet, how the management board of directors are doing. And like doing the technical analysis, we go ahead by checking various graphs, the candlestick charts, and a lot of technical stuff are there in that technical analysis. Sorry. So we can go ahead with these two, but that is too technical for actually me to check on that. So I generally follow these three parameters and one PE ratio, or maybe these three parameters from the particular Excel. Uh, Apart from this, like you can follow the news, follow the budget, in which sectors government is trying to invest. For example, government is focusing on sectors such as infrastructure, road construction. So going down the line, the stocks which are in cement industry, steel industry, they are performing well. There are too much investment, like there are investment going on in EV sector, so those stocks are performing well. So you can check your whatever you have invested in stocks on regular basis. That is advisable. Go through the market trends, what is going on. You can sell, I mean, long term capital gain and short term capital gains will be applicable on those selling and buying or selling of these stocks. But we should always check and go ahead according to the market trends. If you have invested in let's say for example coal, but we all know that the coal industry is not will be not performing the 10 or 20 years down the line. So accordingly, as per the market trends, you should take your decision wisely. And these are the platforms I'm currently using, and these are the books which I have gone through, like read during 2020. Rich Dad and Poor Dad is one of the book from which I have like gained the motivation to how to we should start investing. Psychology of Money is also one of the book which I have read for this journey. That is all from my end. Thank you. We can ask questions.
Anamika, there are a few questions in the chat box. Can you take them?
Okay.
So I think the first was to explain the 100x slide. And
Okay.
when you talked about alpha beta, there was a question about explaining beta.
Okay. One second.
Yeah, just go through the chat box. Maybe you can take the questions as you see fit.
Uh-huh. So beta, the first question is, can you explain beta again? So beta is the variable or parameter which depicts how risky that stock is, in comparison to the index. So if a stock market is going up, so that beta depicts how that stock behave in that situation. If the market is bullish, if the stock will also rise or fall. So let's say, for example, if the beta is 10 or 0.5, we'll start by 0.5. So if a stock market is going up by 10% on a particular date, so that particular stock whose beta is 0.5, that will rise only by 5%. So it is in multiples of that stock. It behaves as per the uh, index. And let's say, for example, the beta is in um very beta is very high. Let's say beta is 10. So in that scenario, if a stock market is low, for example, if the stock market is high, so b that particular that particular stock will raise by 10%, like 10 times of the index. So so that will be a favorable condition. But the risk is, if the stock market is going low, let's say market is going by 50%, and the beta of that if a particular stock is 10, so that particular stock will go by 10 into 50, that is 500% lower. So that is the way of calculating how volatile that stock will behave in according to the index. And talking about the 100x slide, so basically, I have bifurcated like how much percentage of debt you should invest in, and how much percentage of equity of your investment amount you should invest in. So let's say, for example, you are planning to invest 40,000 in a month, and so 100, and you are of age 25 years, so 25% of that 40,000 should be invested in the debt instrument, that is safer instrument. And the 100 minus 25, that is 75%, that should be invested in the equity instrument, that is maybe ELSs, stock market, equity mutual funds. That is the concept behind that. Kalul sir is already have explained them.
Hi, ma'am. This is Pragati.
Hello.
Ma'am, how
Hello,
hello,
Pragati.
ma'am, how Bitcoin and mining is different from stock market? Can you explain this?
I have not invested in Bitcoin, so I'm not the right person to comment on that. Like, I don't know how it is different. That is, I just know that it is a riskier instrument. I have never invested in Bitcoins.
Okay, ma'am.
The next question is, how safe are the mutual fund and which types do to invest in? So mutual fund is more safer than, as Kalol sir has already mentioned, mutual fund is more safer than stock market. If you don't have the knowledge, like which stock to select, is my money safe? Do you, if you have the that like if you have the risk taking ability, you can invest in stocks, like start with the blue chip shares, and invest in those only. But mutual funds are like someone else. A fund manager is there while you have bought that mutual fund. The fund manager is managing those funds. So through mutual fund you can always invest by investing only 500 a month. And by investing 500 a month, you can when you will go through the sector or maybe stocks in which that mutual fund has invested that money, you can see which all stocks you have bought. So by investing only 500 in mutual fund, you can gain, like you can gain the shares of those particular companies, like in a bit and pieces. But when you invest in stocks, you cannot start by 500. At least you, to buy one share, that particular value of that share, let's say 4,000 or maybe 2,000, that needs to be invested in the stock. And mutual fund is safer because funds manager are having experience, and it's their job to do the changes according to the market trends, and according to the senses it is behaving, and how the particular sector is behaving in that scenario. So it will sell some stocks and buy other stocks. Though, so the money, they will try to save your money, safeguard your money, so that is a more safer option. Stocks are direct investment, so there is no one to take care of the market trends. You are the only one who can sell those stocks or buy those stocks. So like there is one app which you can use to invest in stocks if you are a beginner, that is small case. So they also, there is a manager who will take care of all those rebalancing stuff and changing as per the market trends. So you can use small case and invest in stock market. But in that case also, there are some amount charged by small cases, so the whole profit will not be transferred to you. Some commission will be charged by small case. Can you also explain which IPOs to invest in? So see, that IPO to invest in is, I cannot tell you that to which IPO, because it is kind of a bet, because it is new in the market. For example, I have faced that issue. I was trying to buy shares of Tata Technology. Like I wanted to invest in IPO of Tata Technology, but I did not get it, even though I was having the t-shirt share. I did not get it. Then when it is listed on the market, I bought it, and then from that time it is giving low, like minus 20% of return. So that investing in IPO, like I'm not the right person to tell you like which IPO you should invest. That comes by going through the analysis part, uh, technical analysis, fundamental analysis, how that company is behaving, how the sector is behaving, and that will come from experience. I will not suggest you to just go and buy IPO. It will give you, in some cases it will give you a lot of return, but in some cases, like I have faced, you will get a lot of you will lose money. So that is, I'm not the right person to give you any suggestion on that. I have not done intraday trading. it is a risky way of trading. The person who is having a lot of experience and who is actually investing 24/7, like that is their main job. So they are doing intraday trading, or maybe the risk appetite, the person who is having like like high risk appetite. So they are doing that, taking the risk and gaining the return. But I don't suggest people to do intraday trading, because there are chances to lose money in that, and I don't want to. How do you decide the target price for a stock? How do you decide the target price for a stock? This is Anand Raj. I did not understand that question. How do you decide the target price for a stock? How do platforms like Zerodha compare with using bank demand account, demat accounts? I have not used bank demat accounts. I only use various platforms, such as Zerodha is one of them. You can use them. It is very handy. You can keep the app and you invest through app. It is user friendly. So I am using one of them, like Upstocks. I don't know how to go ahead and open the account with bank. That you have to figure it out. So direct option and regular option. Uh, Basically, direct option is the, like, for example, if you are buying mutual funds where you are buying directly from the platform, and there is no middleman in between. Regular options of buying a mutual stock, so there will be a middleman who will be charging some amount by buying, like in some kind of commission in buying that mutual fund, or in while the time of selling it, some commission will be given to the mutual funds, that middleman. Nifty 50, Nifty 100. So Nifty 50 is a index which are betting on the top 50 companies of stock market. So this depicts how those top 50 companies are performing in the stock market. And Nifty is the index which is going along with that performance level. Nifty 100 is also index which is tracking the changes in top 100 companies. It is an index fund. I mean, we can say it ETF, where we can get the chance of invest in these Nifty 50 index or Nifty 100 in 100 index. In Nifty 50 they only consider the top 50, and Nifty 100 they consider the top 100 companies, and they invest in those companies. These are the index which is depicting those 100 companies or 50 companies. What are a few good debt investment options? Debt investment options, you can select debt mutual funds through these platforms. There are specific category which is debt mutual funds coming under these platforms. You can invest through them. Liquid fund is falling under debt mutual funds. You can invest through them. The You will get a lot of mutual funds in these platforms. uh I think it's how. Acha, how to decide target price for buying? So basically, to decide how the target price for buying or selling a stock, I usually follow 200 moving average. So if there is a way to check 200 moving average of a particular stock through the chart, which is there in these available on the platform or money control websites is there. If the price of that particular stock is lower than the 200 moving average, 200 moving average means how that stock prices are falling or behaving in 200 days, and what is the average of that price. So if the current price of that particular stock is lower than the 200 moving average, so I go ahead and buy it. That is also one of the criteria. And if it is high and if I want to sell it, then if I need the money and like looking to the external market trends, we can sell that stock if that sector is not properly uh, going good in that situation. What goes behind the a suggestion of the book? There are a lot of books available in the market which you can go through to have a beginner's idea how to start. And there are a lot of YouTube channels which you can follow to learn about these terms and how to start, how to create a demat account, how to select a mutual fund. So I also got the knowledge from these platforms through the books which I have shared in the last slide. You can use those and gain the knowledge of financial literacy. uh I guess I have answered all the questions. What is systematic withdrawal plan and how it is different from SIP? So systematic withdrawal plan is basically is a way where you have invested, let's say, 1 lakh in a mutual fund, and you have selected a tenure, just like in SIP you have selected first of every month that SIP amount will be deducted. So in systematic withdrawal plan, you should select a date where on which you can receive the interest as a income, like monthly basis. So that is a way to gain, like, have a income. Let's say, for example, you have a need, and you want to, instead of withdrawing the invested amount, you want to use the amount, and it will grow also. It will grow as per the market behavior. The rate interest will, and you will also get a income from that specific mutual fund. And the that is you can do it for maybe 4 5 years, maybe. That depends. I have not done it yet, but that is the basic difference. SIP, in SIP, and systematic withdrawal plan, SWP. Market price. Okay. Can you last slide again? This is the last slide which I was having. I hope it is visible. Buying stock at market price or buying at market limit. Uh, so the difference is like here in market limit, you can limit the uh, price of that stock. For example, if a stock is costing 100 rupees, that is the market price of a stock. And if you have selected the option of market buying at market price, so you will buy that stock in 100 rupees. But you can guess that that stock will lower down. Let's say, for example, it will go to, by the time the market will close, it will go to the 90 rupees cost. So you can select a price according to your guessing capability, or you can select that I want to buy that stock at 90 rupees. So when that stock will reach the level of 90 rupees, that stock will be automatically bought from your demat account. The money should be there in your demat account wallet, and it will buy accordingly. Similarly, you can put stop limit, where if you are seeing that the particular stock is dropping, the price is dropping continuously, so you can put a stop limit that at by this amount, let's say for example, if it is going to 90 and you are putting stop limit at 90, so you can say that at 90 rupees, if it will reach 90, the stock should be sold off on behalf of you, and then the profit will be booked at that amount. What is a good 5-year CAGR for equity mutual fund and debt mutual fund? That cannot be predicted. What goes behind the rising or falling of any stock, like during the recent elections, the market falls and the public sentiment. So all these external factors affect stock markets and how it behaves. Like we have seen during the election time, as you have mentioned, it was fluctuating a lot. And the moment Jay Shankar has given the statement, or Amit Shah has given the statement that you all will earn a lot of money, or when the result was announced, that day the stock market was bullish. So these external factors affect the stock market movement. That is there because everyone started buying those stocks. Like once that news came out, and the investors started buying in the hope of that stock market, that share price will move ahead and I will book a lot of profit. So that haywire happens due to these external news. That is the beauty of stock market, because once the result came, everyone was investing before that, and once the result came declared, that day the stock market was very low, like behaving just opposite what was expected.
Thank you, Anamika.
Which platform app can be best used for buying, selling only mutual funds? You can select any of the stocks as per your convenience. There is no good or best platform. There are a lot of platform. You can use any one of them according to your choice. Okay, I have answered, I guess, all the questions. Like if anyone is having any other question, we can ask, or that is all from my end. Thank you for joining and investing your time on weekends.
Thanks a ton, Anamika. I think everyone found it useful, informative, and very practical. Um, so, special thanks for the session on personal finance management. As Kollol said, a lot of people are interested in this, and we can have a series of talks on personal finance. Thanks to you for this extremely helpful session, and bigger thanks for volunteering, for coming forward when women in the group started asking for a session on personal finance, and I directed them to the ones that we had previously. Really appreciate your effort, Anamika. Thank you very much.
Thank you, ma'am, for giving the opportunity and moving ahead with this. Thank you for your time. Even though you are not well, you have joined for the session. And thank you
I
all
was
for
I was
investing
there for
their
most of
time.
the time.
Sorry, ma'am, you were saying
Yeah.
something.
I was there for most of the time. And the investment has been extremely profitable. People going by people's comments towards the end of the session. Thanks, Anamika. Have a
Thank
great
you.
day, weekend.
You too. Bye-bye.
Bye.
Thank
Bye.
Thank
you.
you.